Hello and welcome everyone to our Financial Fluency presentation, Building Success Through Financial Statement Mastery. I'm Chase Morrison, a consultant at ProfitWise CFO Services in Los Angeles, serving mid-sized businesses for over 15 years. Today we dive into the world of financial statements, unlocking their power to shape business performance. Whether you're a business owner or someone eager to understand financial influence, this presentation is tailored for you. We'll explore how financial statements provide actionable insights for improving profitability, cash flow, and eventually enterprise value. This presentation was originally made at SBA meetings for SCORE members where business owners could get valuable insights on marketing, accounting, as well as financial statements from this presentation. So you may see some dated information in here because this was done a few years ago. If you have questions or need assistance in enhancing your business, don't hesitate to reach out using the contact information provided on this page. If you're ready, let's embark on a journey to elevate your financial fluency and drive success together. So here we have the basic purpose of the course, or the objectives. So when you get to the end of this course, you're going to be able to read a basic financial statement, and you will certainly know what the three financial statements are that are in every kind of business proposition or reporting process. From the smallest companies up to the largest companies, you're going to kind of know what's on the different statements, and you're going to get a little understanding of financial metrics and how they're used to determine profitability and efficiency. We're going to show you how to use the financial statements to build your own projections or a plan, and then through this, we're going to be using examples from QuickBooks reports. So you'll learn a little bit about generating reports from QuickBooks, but QuickBooks isn't so specialized. You can use this for running reports in just about any accounting system. And then we're going to talk about how all the financial statements are pretty much interrelated towards the end, and then go over some benchmarking skills by looking at how you would view your business performance versus other businesses within your industry, which is very helpful in designing how you want your business to work. All right, so you may be wondering, why do we need financial statements in the first place? Well, they're very important. First off, if you think that you're ever going to need to secure a bank loan, you're going to need financial statements to take to the bank, because no one's going to provide you with financing unless you have accurate and timely financial statements. So that's pretty important. Next, if you ever want to attract investors, investors are going to expect you to have financial statements, both projections as well as historical numbers to evaluate, and they're going to be using that to determine, just what your business is made out of. Well, the IRS hopes that you're going to have some financial statements if you're running a business, because that's what you're going to need to file your taxes on. So that is the basis for your tax return if you're a corporation, certainly. Well, this is going to give you something to talk to your accountant about, because accountants are never big talkers. So this will give you something to discuss with them when you meet with them. Hey, if you have a good business, you can always impress your friends with your knowledge of financial statements and how your financial statements work. But really, the reason why you need financial statements are really, it's the basic tool that you need to really, ensure that your business is generating a profit, revenue and profitability continues to grow, and you remain solvent and pay all your bills as time goes by. And these are the most important tools you're going to need to do that. Let's go over the three financial statements. The first is statement of profit and loss, or for short, P&L. A P&L essentially summarizes over some period of time, like a month, a quarter, or a year, what the net result is of all recorded income, less all recognized expenditures. In doing so, P&L validates your business model when income is greater than expenses. If expenses are greater than income, then the result is a loss. Extended periods of losses will eventually bankrupt a business. Consequently, you need to take action to reverse this imbalance between income and expenses. So next we want to talk about the balance sheet. The balance sheet is a listing of assets and liabilities in it. And it reflects the financial status as of a given date rather than accumulating a bunch of transactions over a period of time like the P&L does. So think of, as an example, your bank statement. When you receive your bank statement at the end of the month, it tells you what the balance is in your checking account as of the last day of the month. That's what a balance sheet does for all the accounts, the cash accounts, the inventory, etc., etc. So it is split into two components. One is the assets, and the assets are the resources the business uses, such as inventory, cash, receivables, and the like, that it needs to effectuate the business model that we looked at on the P&L. The second part is the liabilities and equity sections. These two sections report or record the ownership of the company's assets and can be thought of as differentiating in between third-party ownership of assets like debt holders or accounts payable for vendors, which constitute all the liabilities section. The equity section is kind of what's left over after subtracting liabilities from assets, and that is the remainder, which is really the part of the business that is owned by the stakeholders. And lastly, let's go over the statement of cash flows. Now, the statement of cash flows is similar to the P&L in that it is reflecting what the cash flow status is from one period to the next. So say you had X amount of cash at the end of February, and then you have Y amount of cash at the end of March. The statement of cash flows is going to be analyzing what the changes were between profitability and activity on the balance sheet. So back to our checkbook example, assuming your bank balance went from $3,000 at the end of February to $5,000 at the end of March, that may be partially due to you spending less money than you earned, but also may be the result of the bank advancing you cash in the form of a loan, which is a very different thing than you spending less than you earned. Anyways, the cash flow statement attempts to detail the sources and uses of cash to help better manage this most important resource. With that, let's dive into the balance sheet in a little more detail. In order to understand balance sheets, you need to understand what a balance sheet is attempting to communicate. And right here in this first statement, it basically categorizes what a company owns, which is basically all the assets, and what it owes. And what it owes are liabilities as well as equity to all the stakeholders. So starting on the left side, what a company owns, these are obviously the assets, the non-people related resources needed to generate revenue. And some of the things are going to be cash, receivables if you invoice customers for sales, inventory if you're a product-based company or distributor. You may have equipment as in the form of fixed assets, and then intellectual property, which can both be intellectual property such as IP as well as goodwill. Now as we move over to the right, you have on the top you have liabilities. So again, these are things that the business owes money to, and these are third parties. So vendors bill us, and then we record accounts payable. Lenders, if we have debt, like the SBA or the bank. And then there's also employee accruals, things like vacation. That is a liability when an employee has accrued vacation that is owed to them. And then if you take assets in total minus liabilities, then that leaves equity. And equity is typically made up of capital stock as well as retained earnings. Capital stock is the initial investment that a owner makes in the business. So if you start a business and you put $10,000 into the business to get it going, you're going to have $10,000 of capital stock and $10,000 of cash on day one. Retained earnings is the accumulation of profit and loss that flows from the P&L to the balance sheet. So let's take, for example, if you did the $10,000 basic investment in your company and you lost $2,000, you might have a negative $2,000 of retained earnings, which means your now equity position is $8,000 rather than your initial $10,000. But kind of the key to all this is at the bottom, you can see that it is all about connecting things or assets to people, investors, vendors, and lenders. That's really what the balance sheet is attempting to communicate to users of this financial statement. Now, a little bit of accounting knowledge, I think, is due here, and I didn't want to go too deep into the weeds on accounting, but basically wanted you to be aware of the differences in between cash basis accounting and accrual basis accounting. Now, cash basis accounting is basically what you would look at if you were just running your business through your checkbook, but you can do it through QuickBooks or other accounting systems. In fact, QuickBooks is pretty elegant about allowing you to switch in between looking at reports on a cash basis or on an accrual basis. But just looking at cash basis accounting for a moment and the advantages and disadvantages, you can see here, it's simple. Generally, it's going to align with the way that you do your taxes if you're of a small business size. It doesn't require a whole lot of thought relative to how you're posting entries. One of the big disadvantages, though, is that it's a mismatch of income and expenses, and more on that in just a second. It tends to understate liabilities, and it is basically worthless as a financial analysis tool. Moving on to accrual basis accounting. Now, what accrual basis is attempting to do is to reflect what's called a matching principle in accounting. And the matching principle in accounting means that you're attempting to match revenue with expenses. So this is pretty straightforward if you're in an inventory business or distribution business where when a shipment goes out, you record the income and you record the expense. It becomes less clear if you're in, say, professional services or some other type of business where it's less obvious as to how to match up revenue with expenses. But here's the advantages and disadvantages. It gives a true representation of how the business is performing. So meaning that when you're looking at gross margins, operating margins, return on sales, you're looking at a pretty true representation of how profitable the business is. And it also allows you to look at trends over time to see what's changing. This is one of the big disadvantages of cash basis because you can incur a lot of expenses in a cash basis firm, and all of a sudden you get paid 6 months later and you have this whopping income while you've had 6 months of losses, which is not helpful for analysis purposes. So accrual, it enables more reliable financial analysis. And basically, if you're going to have an investor or a lender looking at your financial statements, they're going to want to look at them on an accrual basis. The IRS, they're going to want to see them if you're a small business on a cash basis. The disadvantages, obviously, is it's more complex, requires somebody with more accounting knowledge. There's going to be a few more transactions. And, you're going to need some skilled people to administrate accrual accounting. Otherwise, you're going to be making a lot of mistakes. Just very quickly, we just wanted to show you how you could go and get a balance sheet out of QuickBooks if that's the accounting system that you're using. So obviously, you would start up at the top menu bar with Reports and then select Company Financial. Then select Balance Sheet Standard. That's the one that we're selecting here. And you can see that the accrual basis accounting is the basis used to generate this report. And then down at the bottom, you can see how you can switch the report basis in between accrual versus cash. And the numbers that are on this balance sheet are the same ones that we're using in our examples that you'll see here shortly. You can see there that the total checking and savings was $25,802, and the receivables were $93,752, and so on and so forth. But you can't really see it because that one dialog box is hiding the remaining information. So looking a little bit deeper into the balance sheet, let's start with the assets. So again, Assets are what a company owns or the resources it needs to effectuate its business model or to generate revenue. And as you can see over here on the right, that assets are split into two different broad categories. One is current assets and the other is long-term assets. Current assets are those assets that are to be converted into cash or can be converted into cash within the next 12 months. Long-term assets are those that are greater than 12 months. As you can see, the assets are ordered by their level of liquidity. So obviously cash is the most liquid asset, followed by receivables, and so on and so forth. A test that you can use to evaluate whether an asset really is an asset is if you look at it and you have to ask yourself, can I, in the event of a bankruptcy or having to wind down the business, convert that asset into cash? If the answer is no, then you probably have what would be termed an impaired asset. And you really want to keep an eye on assets because when and if you eventually go to sell your business, your prospective purchaser is going to be scrubbing those assets very closely and will adjust the purchase price of the business based on impaired assets if there are any. So here we are switching over to the other side of the balance sheet, which is the liabilities and equity section. And those two obviously are split into two pieces, but the liabilities section, similar to the assets, are split into both current liabilities and long-term liabilities. So again, these are split by how soon, or I should say these are ordered by how soon payments are due. Long-term liabilities are liabilities that are due in over a year and longer. Current liabilities are those that are due within the next 12 months. Following directly below the liabilities section is the equity section. And within the equity section, there's two subcategories. One is the paid-in capital section, and the other is the retained earnings section. Paid-in capital is basically the capital that is paid into a business by the owner to initially start the business and obtain the stock at the beginning of the business. That number should not be changing just about ever unless you happen to take on a new owner that is providing you cash and wants equity in the business or a percent of the business. So if you want to provide somebody with 10% of the business for X amount of dollars, and this number would change. Otherwise, it's going to remain the same. Retained earnings represents the accumulated amount of net income that has occurred over the life of the business. And over here on the right, you can see that it is split into two pieces, and this is a QuickBooks way of showing retained earnings. So it splits it in between prior year or years and then current year. So for this business, the current year retained earnings of $88,690 is basically the net income also. So those two numbers are going to be exactly the same. All right, now with our balance sheet primer and behind us, now we can kind of go through and take a look at a couple quick balance sheet metrics that are pretty common. The first one here that we're going to talk about is the quick ratio, and both of these are ratios dealing with liquidity, but the quick ratio is trying to show you in the event of an emergency, what are the quickest assets you have to convert to cash, which is going to be cash and accounts receivable. And if we divide that total by your current liabilities, which right now is just accounts payable and current liabilities, then we get a ratio of 1.23. That is a good thing. We would always want to have more than $1 of quick cash assets to go against our current liabilities. The next one is the current ratio, and the only difference in between this one and the previous one, it's probably more commonly looked at, but we also include inventory and other assets. So this is not as quick to cash, but over several months, how would we do? So a good metric would be 2 to 1 for the current ratio, meaning we have at least $2 of current assets for every $1 of current liabilities. That is a pretty safe margin. Here we have over 3, so we are in even better shape than 2.0. Overall, our company has enough liquidity to cover its current bills, which is a good thing. All right, well, that's enough for the balance sheet for now. Now we move on to the profit and loss statement, or what we're going to term P&L. Now, as we mentioned earlier, there are a number of different names for the profit and loss statement, and you can see some of them there. Now, the profit and loss is basically what you're going to want to use to tell you whether you have made a profit or you have a loss over some given period of time. Now, the profit and loss statement is going to sum up all the income and all the expense activity over whatever this given period of time is, and it's going to tell you whether or not you have a net income or a net loss. Because of that, it's extremely useful for validating whether your business model is making sense relative to, are you able to charge more for your services or products than they are actually costing you. One erroneous thing is assuming that if you do have a net income that you're making money, really you don't know if you're making money unless you're able to put more cash in the bank than you're putting out, which you're going to be able to see on the cash flow statement. So you have to kind of wait to figure out if you're making money until after you have some collections. If you happen to be a QuickBooks user, here's how you go about finding your profit and loss statement. You start over here up on the top menu at Reports, and then you want to select Company and Financial, and then from there you would pick Profit and Loss Standard, and then you would see the report that's down here in the lower right, and you could select Modify Report if you want to change the period that you're looking at. Here in this period we're looking at an entire fiscal year. Then obviously if you select Modify Report, you can switch in between accrual basis versus cash basis. Now again, you're typically going to be looking at your financial statements on an accrual basis. So when your accountant calls you and they want your financials to do your taxes, you're going to select the cash basis and create both a profit and loss and balance sheet and send it off so that you can file your taxes. Drilling down into the P&L a little bit further, this is the typical composition of a commercial profit and loss statement. At the top is revenue, and that is followed by our first of 3 categories of cost or expenses. So that is cost of goods sold or cost of services provided, say in a professional services firm. But cost of goods sold or services should be relatively variable to revenue. As revenue increases, so does the cost of those services. You can see this most easily in a product-based company where as customers are ordering and purchasing products, the cost of those products are falling through cost of goods sold as standard costs or average costs. And they go from the balance sheet as inventory costs to cost of goods sold and become what's called an expired cost. Revenue minus cost of goods sold is gross profit for our first key measurement. You can see here in our example, the gross profit margin is 40.5%. That tells you that for every dollar of revenue we earn, we have slightly less than 60 cents of expenses associated with that. So then that begins to create the pool, the gross profit, for the next category of expenses, which are called operating expenses. Now, operating expenses are things that don't directly involve the delivery of products or services for a firm. They consist of things like sales and marketing, research and development, administration, and other categories such as those. I've not broken the operating expenses into those types of categories, but suffice it to say that these could be the administrative expenses for running this business. Then you can see the total operating expenses, and then you get to the operating income and loss, which is the next key metric. You can see our operating margin is 18.7%. Now, this is the profitability of the business that is what is at hand. You can see that for every dollar of revenue, it's costing us about 80 cents, slightly more than 80 cents of every dollar to run the business. Now, is that a good number or a bad number? I mean, you have to do some benchmarking against other companies within your industry to decide whether that is a good number or a bad number. And then the third category of costs is this other income and expense category. So these are expenses and income that are not really germane to the business's business model per se. Say, for example, here we have interest expense. So debt is not really part of the business, but it is related to debt that the business has had to take on to run it. But we could also have other income, for example, if the business had too much real estate and they had to sublease some of the real estate, they might have other income relating to rental income for that space. But this business is not in the business of renting out space, so that income would fall into this category. And then finally we get to net income. This business had net income of about $89,000, so that was an 18% return on sales. Here's some more basic analysis on our P&L that we looked at earlier. So above you can see that we've spiked out the cost of goods percentage, which before was hidden. You had to subtract 1 from the revenue number to get that, and then you can see what the gross profit is. Again, most of the cost of goods is primarily variable, as you can see there. Then you can see on operating expenses what the percent of wages is of total revenue, and then insurance and so on and so forth to get down to the total operating expense of 21.8. Then again, you can see our operating income at 18.7%. Then we have a little bit of other income and expense, and then we get to our net income. And finally, I have a simple, quick and dirty break-even analysis down here. So you can see what this is saying is that since most of the expenses are fixed in operating income and other income and expense, those two total about $109,000. So in order to get to the break-even, you need about $268,000 in revenue to break even or to have a zero net income. Just about anything beyond $267,000 in revenue is going to deliver net income to the bottom line with this business model. And all you need to do is just solve this simple little algebraic equation here that I put over here just to the right of the break-even analysis. Well, that's it for the profit and loss statement. Now we move on to probably what is the most difficult to understand statement of the three, the cash flow statement or statement of cash flows. And really, it's not all that difficult if you know what the cash flow statement is attempting to convey. But basically, what it is attempting to convey is the change in cash from one period to the next. Or it is attempting to bridge cash balances from one period to another period. In this example, you can see down here at the end of this first year, the cash balance was about $78,000. And then in the following year, it dropped down to $26,000. So that's actually a drop of $52,000 in cash, or what we're stating there as a year-over-year use of cash. A reduction in cash is called a use of cash, and an increase of cash is sources of cash. The cash flow statement will break down the sources and uses of cash into three categories. The first one is probably the most critical. It's called the operating cash flow. And that is basically the cash flow that the business is either generating or using for business operations, or you could say organic sources or uses of cash. The next is investing cash flow. That's typically pertaining to the purchase or sale of capital equipment. But if the business also has enough cash that it's investing some of that cash, say, into the stock market, then the results of its stock activities or bond activities would be uses and sources of cash. And then the last one is financing cash flow. That is mostly pertaining to a business getting debt to operate with. So bringing new debt into a business is a source of cash because that's going to increase cash, but it's also going to increase debt. Also, an owner that is putting equity into the business, or investors that are putting equity into the business, that would be financing sources of cash. Now, there are two types of cash flow statements, the direct and indirect. We're basically going to be focusing on the indirect method in this discussion. Here's a little cheat sheet on how you can calculate out cash flow if you so desire, at least using the indirect method. You can see at the top we start out with the operation cash flow items, and then that's followed by the investing cash flow items. Finally, at the bottom you have the financing cash flow items. So if we go up to the top and we look at the operation cash flow items, the first one you see is net income / loss. As you can imagine, if you have net income, that is going to increase cash flow, and a loss is the inverse. Now, the first two items, accounts receivable and inventory, those are assets. When assets increase, those are uses of cash, or they reduce cash. So think about it. You extend accounts receivable to one of your customers. Essentially, you are giving them a loan. Accounts payable and other accruals, those are liabilities. When those increase, then that increases cash. So again, if you think about accounts payable, that's one of your vendors loaning you money. So hopefully that makes sense, that as accounts payable increases, that increases cash because you are borrowing someone else's money or using their money. Then moving down to investing cash flow, you can see the most common item there is fixed assets. So as fixed assets increase, obviously that's going to use cash because you're purchasing fixed assets. Depreciation is really a non-cash expense, so you add back any depreciation to your cash flow calculations. It's just an accrual or a depletion of your assets, but again, it's a non-cash expense. Then finally, moving down to the financing cash flow, we want to look at debt and any equity transactions. So any increase in debt is going to increase cash, and conversely, reduction in debt is a payment of cash. And then equity is just if you have someone providing more cash into the business, or you yourself providing more cash into the business, as equity increases, that's going to be a cash increase. And then you add all that up, the operational cash flow, investing cash flow, and financing cash flow, and that gets you the total cash flow for the month. At the bottom, there's a couple notes here. Ignore retained earnings on the balance sheet. Obviously, we don't include cash because we're computing how to get to the change in cash and distributing it out to all these categories. And then finally, depreciation is a non-cash expense, so it gets added back. Once again, moving back over to QuickBooks, we can take a look at a statement of cash flows report. So you would go to the reports menu option again, company financial, then you would select statement of cash flows, and then that would generate this report over here at the right that we're going to talk about a little bit more in detail. Let me increase the size of it to make it a little bit easier to view. First off, you can see that our QuickBooks cash flow statement is broken into three categories. You can see the operating activities, the investing activities, and then down at the bottom, the financing activities. Let's drill into the operating activities because that's the most important one. First thing we can see here is that we had an $89,000 net income. That's excellent. And moving down, we can see that accounts receivable used $82,000 with cash. That means that receivables increased. And remember, again, that is the business making loans out to its customers in the form of receivables. Now, materials inventory increased, so that means that used more cash because we increased our materials inventory asset. The same with work in progress, increased $39,000. Then you can see that finished goods inventory generated $190,000 in cash, and that's because finished goods inventory went down from the end of 2014 to the end of 2015 because of shipments that we made to customers. So as products go out the door, inventory goes down until it is replenished. Accounts payable produced $88,000 in cash. That means that accounts payable went up. Remember, that is our third-party vendors lending us money, essentially. And then if we go down to the next material item here, the line of credit, the line of credit consumed $59,000 in cash. And that means that as of the end of 2014, this business had a line of credit with its bank, and that it paid down that line of credit $59,000. Moving on to the investing activities, there's just a small amount there. It looks like we would have purchased some computers or office equipment for $2,500, and then reversing the depreciation for the 2015 year, that would be the $900. The investing activities just consumed about $2,000. And then finally, going down to financing activities, you can see that our owner, Deborah Wood, took an owner's draw for $135,000. That means she took $135,000 in cash out of the business. And that would be different than, say, a W-2 payroll payment. This is an owner's draw, and it gets taxed differently. But if we take the operating activities of 103, a positive, minus the $1,600 investing activities, minus $135,000 in owner's draw, the business consumed about $33,000 in cash over the course of 2015. That's a pretty good result. Seems that the owner was able to withdraw $135,000 in cash, pay down debt almost $60,000, and still only impact overall cash by $32,000. So that's just how you can infer some information from looking at this all-important statement of cash flows. This really is where you find out if your business is making money or not. Now that we've wrapped up looking at all three of the key financial statements, let's talk about some additional ways to look at financial metrics to evaluate how a company's doing. Now, we've already looked at two earlier. We looked at the quick ratio and the current ratio, but here we're going to look at 7 more ratios that you can use to analyze how your business is performing. The first is return on sales. So that's going to be net income divided by sales. And clearly that's a profitability measure. The higher the number or percent, the better. Return on assets is going to be net income divided by assets. So that is a return on assets measure. And again, you remember earlier that we talked about assets being all the tools and resources that a company uses to run its business model. This is a way of looking at just how profitable each one of those dollars of resources are relative to generating net income. The next one is return on equity. This is net income divided by total equity. And again, this is a measure of how much income each dollar of equity is generating. Now, we have an article on our website that really dives into return on equity and something called the DuPont formula that was created by a gentleman that worked for DuPont back in the 20s, and it goes deep into ways of using return on equity to really drive business performance. Highly recommend you take a look at that article with a reference down below in the description. Next is day sales receivable. So this is accounts receivable at the end of some period, say the end of the year, but any period, where we divide the total receivables by the daily sales. And typically it's over the last 365 months of activity. So sales divided by 365 days comes up with what the daily sales average is. So you can see dividing accounts receivable by that number is going to tell you how many days of sales on average it took you to accumulate that amount of receivables. The smaller the number there, the better, because you want fewer days of receivables, and which has an indication as to what kind of terms you're giving your customers. Next is days of inventory on hand. So that's going to be inventory divided by cost of goods or cost of sales, which cost of goods or cost of sales is the cost of inventory as it goes out the door, divided by 365 days. Again, this is telling us how many days of inventory we have on our balance sheet, and that measure equates to how many days it would take us at our current sales volume to extinguish or sell off our entire inventory. Again, you want that number to be as low as possible because you want to be maintaining only a small amount of inventory, or at least as much inventory as it takes to keep your customers happy. The next one is days payable outstanding. So this is going to be accounts payable divided by all disbursements divided by 365 days, right? That's going to be your daily disbursement amount. You can come up with disbursements by looking at all the checks and cash that's issued out of the business and divide that total amount by 365. This is going to tell you how many days of payables or the average terms you're getting from each one of your vendors. Clearly, the higher the number here, the better for you, because that means you're getting more time to pay your bills versus if you look at the terms, the day sales receivable, the terms that you're giving, you want that number to be lower. You want the DPO to be higher. And then cash cycle is basically taking the day sales receivable in days, the days of inventory on hand in days minus the DPO. And in effect, what this is it's a measure of the amount of time it takes you from the first dollar out, say when you purchase inventory and you pay for inventory, till when that inventory dollar or the sales dollar comes back in. You want that number to be as small as possible. Let's look at how we might apply some of these ratios or metrics to an actual case. Now, we're not going to look at the profitability metrics. We're just going to focus on these efficiency metrics. But let's start with the day sales receivable metric. So let's assume here that we have a business, and as of the end of 2023, we had $94,000 in receivables outstanding. Then we want to come up with what is our daily sales numbers. We look to the profit and loss statement and we see that we invoice $487,000 worth of sales during the year. We divide that by 365 days, and then that gets us to our 70 days of DSR, or day sales receivable, that are outstanding. That is the average amount of time it's taking one of our customers to pay us. And that's a pretty long amount of time. That's a little more than 2 months. It's almost 2.5 months. So you have to think, how many vendors do you have that allow you to take almost 2.5 months to pay a bill? Probably not very many. I mean, if you think about your mortgage, if you have a mortgage, your mortgage becomes due on the first day and you have 15 days to pay that before it's late. And here this business is giving its customers 70 days to pay the same type of bill. Next, days of inventory on hand. Again, we look at our balance sheet on 12/31/2023, and we have $155,000 of total inventory on hand. That includes raw material, work in progress, and finished goods. And we divide that by our daily cost of goods going out the door. We had $289,000 of inventory go out the door over 12 months. Again, that number is going to be on the P&L. And we come up with 195 days of inventory on hand. That's telling us that, again, if we were to stop bringing in any new inventory, it would take us almost 200 days, or 2/3 of a year, to sell off all the inventory. Was that too much or too little? Well, that kind of depends on a couple of factors. But let's say if you were getting all your inventory, say from China, you might have some pretty long lead times. A lead time of like 3, 4, 5 months is not out of question if you are getting new inventory from overseas, somewhere in Asia. Now, days payable outstanding is looking at our balance sheet to get the accounts payable balance. We have $35,000 in accounts payable. Now remember, that's as of the end of the year, how many bills we have due to be paid in, say, 2024 that are still on our balance sheet. We look at our total disbursements over the course of 2023, which was $395,000, and we divide that by 365 days to get our daily disbursement average, and that gives us a DPO of 32 days. That is the average time it's taking us to pay a bill to one of our vendors. So that is not too bad. I wouldn't think that 32 days on average is too high. Now we look at the cash cycle where we bring the three together. If we take our 70 days of receivables outstanding plus 195 days of the inventory that we have on hand minus our 32-day DPO, that gets us to 233 days cash cycle. That means that from the first day one, when you put $1 out to one of your vendors for inventory, if you're a product-based company, for inventory that you brought in, till the day that dollar comes back in the form of a paid invoice where you gave somebody 70 days terms to get that invoice back to us, it took all that time. That is quite a bit of time, depending on what your lead times are for inventory, but you would probably want to focus on both decreasing DSR and maybe getting some better terms with some of your vendors. We have clients that have very good long-term relationships with their Chinese vendors that provide them with inventory, and they have up to 90 days of time to pay their invoices with those customers. Well, that's about it for our financial statement primer. I hope you found that useful. We certainly provided a lot of information that I think you will be able to put to good use in your business pursuits and helping you understand what's going on with your business and financial statements. Here's an appendix with all the financial ratios that we just went through, as well as a few others. If you're interested, please subscribe and give us a comment down below if you have any questions, and best of luck to you in all your business activities.